Is less than 0.5% at the moment, despite efforts to push it much higher. That means the area is now flirting with deflation, which leads to economic contraction and job losses. Today's announcement means new stimulus measures of up to $1 trillion. But the ECB has stopped short of announcing large-scale buying of government bonds, known as quantitative easing. And it's the same program that America is withdrawing. So what do these ebbs and flows mean for our own economy at the moment? Well, to discuss, we're now joined by Portfolio Associate at ACM Gold, Mapianine Apiri. Great to have you with us.
Thank you.
Mapianine, so what does this announcement mean for us?
Well, the most obvious implication for South Africa and some African economies is that there's definitely going to be a slowing in export growth. What it means is that if there's low demand within the Eurozone, then that means South Africa, and it just happens to be that the Eurozone is a key trade partner with South Africa. So we're definitely going to experience a lot of slowing down in exports. And as a result, that could impact their current accounts.
Well, we're seeing those figures. We're so reliant on imports. Our exports are dwindling. Some people say it's an own goal as well. We're not manufacturing very well. We're not manufacturing efficiently. We're not exporting. We're not making enough things, basically.
Precisely. And
is it a combination of both factors?
I think it is a combination of both factors. But quite largely it's due to the fact that we do have softer commodity prices. And a lot of African economies used to benefit from that. And now we've seen the commodity prices drop quite considerably this year. And in combination with the Eurozone slacking and a slump in growth, that is given the impact that we're currently seeing in our domestic economy.
Just put this all in context, because the financial crisis hit, everything went down, but now it feels like the seesaw or so uneven. So America's looking better, they're withdrawing all their stimulus, but the Eurozone is now stagnating.
Precisely. I think if we look at the two economies separately, we'll notice that America was very focused on the labor market. Immediately after the financial crisis, the Federal Reserve took a stance to pretty much support the labor market and decrease unemployment and increase the wage in America. And that seems to have worked very well for America. But then again, monetary policy is not a copy-paste. It's not a situation where you can apply what has worked in America does not necessarily mean it's going to work in the Eurozone.
It's very interesting what you say. Explain that about wages in the context of us about to establish a minimum wage.
Well, if a central bank prints money or is involved in some sort of monetary policy to boost the economy, they sort of have to decide where exactly they want to have an impact in. They have to put measures in place that will ensure that that money actually gets to the relevant areas. So if that's a key concern, if unemployment is a key concern, then the onus is upon the central bank to make sure that that money actually gets to the underlying issue.
So how did they channel it? Because they put more money into the system. That usually means that banks lend more, consumers spend more. Was it just that effect that led to job recovery, I suppose?
Precisely, and there's also various other policies that will obviously affect that, but the idea is that if banks can start lending more and aren't afraid to lend to each other and lend to the general public, eventually that money will start circulating within the economy and boost that economy.
Well, of course, that money circulating in America also made its way to South Africa. Our markets have been boosted. There was a lot of concern when they started withdrawing the stimulus that would affect us. You've actually noticed, I think, some withdrawal of foreign direct investment. Can we make up the gap if the Japanese and the Eurozone start stimulating their economies now at great length?
Yes, definitely. I mean, it was very evident that there's less foreign direct investment coming in, as well as there was a bit of a reaction on the JSE All-Share Index. We saw it reach an all-time high this year, and right now it's probably retracing due to global concerns of the global growth, and as well as the end to QE from US Federal Reserve. Ultimately, to be honest with you, if the South African economy is to progress, we really have to deal with the domestic issues, the structural challenges that we face. Those have to be dealt with. The international community and the developed economies do play a role, but ultimately the ball is in our court in terms of sorting out the issues that we face locally.
We do have some power, and a lot of people are saying that. Finally, just looking at the withdrawal of QE in America and what we're seeing in Europe now, can we at least say that the reaction in South Africa wasn't as bad as we thought? People were talking about a market crash, a lot of woe, the end.
It's not as bad. Also, given the fact that we are getting other investments from, for instance, Japan, and we're expecting a little bit of some capital inflow from the program that the European Central Bank is intending on engaging. So not much.
Is it significant? Is it significant enough?
It is significant enough. I mean, it's a couple of billion euros, and it will definitely filter its way into our economy or into our local market.
All right, thank you so much for your analysis. That was Mabianine Piri from ACM Gold. Well, the higher European markets that we saw today failed to lift the JSE. It ended 0.25% in the red. The miners did well, but the retailers ending well down. Truworths released a statement, a trading statement that disappointed investors. It plunged by more than 7% today. Let's take a look at your main financial indicators. Great to have you with us on Business Review.